So I'm seeing that right now, and the market hasn't adjusted. Just wait, it's gonna be crazy. So if you're trying to get in the market, the next 4 to 5 months is your window. This is like you're gonna be kicking yourself in the butt if you don't get it now. I keep telling my friends, all my personal friends, I'm gonna buy a house. I don't care if you use me. You're gonna thank me one day, and I truly believe in that. The next 4 months is your window.
All right, guys, welcome to another episode of The Report. Today, I got my first repeat guest of the history of this podcast. He was on episode 77. He's a good friend of mine. He's in Fast Lane Drive. He's funded over $5 billion worth of real estate loans. I got my man, Chris Groves. Chris, welcome to the show.
Thanks for having me, brother. Good
Yeah,
seeing you.
dude. Appreciate you coming on again, man, as a repeat, dude. Big fan of you and Aleyna. I ran into you guys last at the, it's been a little bit. I didn't make it to the Christmas drive. Were you guys there?
We did show up at,
Yeah.
at night. At night, we were filming a show in the morning. Actually, our pilot for that we were filming in the morning, but we made the night party.
Yeah, dude. So I didn't make it to the Christmas one. There's an event this weekend I really wanted to go. It's the first one of 2024 here in San Diego, Fast Lane Drive. And I'm going to be in Miami, unfortunately, out there with Wolf of Wall Street.
Unfortunately,
Yeah. Jordan Belfort, Wes Watson. It should be fun, but
I love it.
next time I'm in town, dude, I got to make it to an event.
We're doing it.
Yeah,
Miami's
yeah.
not a bad place to land, though.
Dude, tell me about this TV show that you and Aleyna are working on.
So we're working on it's a power couple show. It's called Vows to Ventures. So one thing we've gotten a lot of as we've grown in our businesses is, husband and wife. How do you run a business, not kill each other, still have a successful relationship romantically and financially, and have children, right? So we started pitching the idea around, and then I'm good friends with Glenn Stearns and his wife, and then we met another couple. So we kind of put this concept where it's going to be 3 power couple mentors. It's kind of like Shark Tank meets The Apprentice meets The Voice. And we're going to be choosing what couples we want to take on. They have to be in a relationship, married or in a relationship, running a business, trying to scale to the next level and be crowned the next power couple. It's through like challenges, mental, physical, emotionally, marketing. And then they're going to be whittled down to one couple at the end, of course. It's going to be all within the positive mindset, being an entrepreneur, what the American dream really is, starting from nothing and building a huge empire. So I'm excited because that's what I believe in. I don't want to watch trash TV with a bunch of drama and distractions. I think everyone wants to get to that level, but they've never seen a roadmap to do so. So hopefully with this show and its message is going to help inspire people get to the next level.
Yeah, I love the concept because, for me, it's like if I'm going to watch TV, I always enjoyed watching things like Shark Tank because you get to learn a little bit and like kind of hear about these different business ideas. And so it sounds like you guys are really doing that, but from a couple perspective.
Yeah, I mean, with couples, obviously it's the emotional aspect of running a business and trust and partnership, and that takes coaching and mentoring and a lot of people how to put it together. Like everyone would love to do that, but how to actually put together and make sure it functions correctly. And not you have a good relationship is one thing, but running a business is another thing. And then you have kids on top of it. That's a lot. How do you
Yeah,
manage it all?
it's 3 different elements.
How do you take it all on?
Yeah, that's interesting. Well, dude, I really wanted to bring you on again because, obviously there's a lot of changes in the lending environment. We're about 2 years removed from this increasing interest rate environment. We saw a lot of volatility in the marketplace. There was a lot of bad news out there. We've seen buyers on the sidelines. But I got to be honest, given the scenario that interest rates essentially, more than doubled in the last 24 months, that in, a lot of these major markets around the country, housing prices really, and real estate in general, really held up just fine. We didn't see this big crash that everyone alluded to. And now, we're in election year 2024. We're seeing a lot of signs that the Fed is going to start doing rate cuts this year. Inflation's back down to where, the target really is. And so now we're seeing talk that we might see a smooth landing. And so I'm just like in shock that it was not affected more.
Yeah. Well, I mean, the biggest thing, and a lot of people always glaze over this, COVID shut down the production of new home developments as well, right? So during that time, we were backlogged 3 years on new home projects, right? Even right now, doing lending in the commercial space on dirt, like trying to get dirt lending on it, it's very tough. So it's even hard for builders, even currently in this rate environment, mainly because people don't know what's going to happen with the marketplace. So volume's low, there's no inventory. There's still demand, and there's a lot of people sitting on the sidelines waiting for the fives to hit before they get in the market. And as soon as that happens, it's going to go crazy. It's going to be 26 months in again, and you're going to see prices rise even higher, if you can believe it.
Yeah, you're exactly right, though. I think, with COVID, there was a pause in new builds, new construction. And if you look at a lot of the major markets in the country right now, there is a shortage of supply to meet the demand. And if you look at the demographics and household formation, and this is kind of a macro perspective, you got the baby boomers that are living longer now, right? So they're not moving out and selling their homes and going into retirement homes as early as they once did. And then in addition to that, You got the baby boomer, I'm sorry, the millennial generation that is starting families for the first time. They're buying their first homes to raise their families. And then you got the Gen Zs that are just as big as the millennials. And now they're moving out of their parents' house. They're renting apartments for the first time. And so they're looking for places to rent. And so you got this massive demand. And then because of COVID, there was a big pause in new builds. And then this high interest rate environment that we've experienced in the last 24 months and all the uncertainty of the marketplace, a lot of new builders are like, hey, I'm gonna sit back and see what happens before I jump back in. So now there's less new supply being brought back to the market, and I think all of this is, when you see the pricing not being too affected because of the high interest rate environment, I think it's a testament to all the built up demand and the lack of supply.
Exactly, exactly, and like you said, exact with the baby boomers not moving out, because the thing with most of us, right, even as we progress in life, people with kids, like every 3 to 4 years, we're usually moving up the next home, right? Like, oh, next level up. But the interest rates have enabled people to say, hey, I'm gonna hold out. I'm not gonna move up with this higher interest rate. So it's settled them. And same thing with baby boomers, like, hey, I could downsize, but at that interest rate, I'm gonna be paying the same thing. So I'm just gonna chill in this house until things adjust. So as soon as things, like I said, I know as soon as things hit fives, I think it's going to be gangbusters. Like everyone's going to go nuts, and prices are, you're going to see, like, I mean, I was doing offers a day. I had 16 offers on a $750,000 property out in like Temecula. I was like, what the heck? And it was just POS. It wasn't anything special. So I'm seeing that right now, and the market hasn't adjusted. Just wait. It's gonna be crazy. So if you're trying to get in the market, the next 4 to 5 months is your window. This is like, you're going to be kicking yourself in the butt if you don't get it now. I keep telling my friends, all my personal friends, I'm going to buy a house. I don't care if you use me. You're going to thank me one day. And, I truly believe in that. The next 4 months is your window.
Dude, I completely agree with you. I've been saying the same thing for months now. I'm like, look, the deals are out there for the ones that, are actually putting the work and submitting offers. It's all a numbers game. But right now, there's no buyer competition. But I guarantee in 6 months, that's not going to be the case.
Yeah. And the biggest thing, you're not marrying an interest rate. You're marrying a purchase price. So if you get a better deal today at a purchase price, fine, we'll refinance you and get you a better rate later on, but you're going to get a better price in that house. And at the end of the day, you can't change that. So yes, you're marrying the purchase price, not the interest rate.
Yeah, no, I love that. That's good stuff there. So, since the news kind of turned around in the marketplace, we're seeing spreads kind of come down over the last couple months. What have you been seeing on your end with the spreads coming down? Have you seen a lot of new loan applications for refis and purchases?
Refis ticked up a little bit at the end of December when we had the big adjustments. We're down in the sixes. We're starting to see VA and FHA streamlines kind of kicking up again, because obviously those adjustments happen around 30, 40 basis point differential. So we saw them kick up a little bit. And then obviously in the last couple of weeks, it ticked back up a little bit. But it's still, I think we're around in the mid sixes for most of our product types at this point. Like I said, the people that are buying the most properties right now are investors, right? They're smart enough to go, hey, I like what I just said earlier, like they understand that concept and they're going to try to find a deal. So the biggest thing is you don't get a deal unless you get out there and make an offer. So stop sitting on the sidelines and saying, hey, I haven't found the right place. If you're not making offers, you're not doing anything to get in the house. You're not doing enough. So if you really want it, get out there, make a good make offers. If you get it, great.
Mm-hmm.
But you can't get a deal unless you make an offer.
And I also say, like, just because the pricing guidance or the listing price is not a number that works for you, well, that doesn't mean you don't submit an offer. Submit an offer at a number that works, because seller expectations change. They really do. And so, especially some of these deals have been on the market for a little bit, 90 days, not a lot of activity. Well, some of these sellers need to get out, and we're seeing this on our end in the boutique hotel space. There's deals that are shaken loose. And so just because the pricing guidance or the listing price is a specific number, that doesn't mean you just pass. Submit an offer at a number that works, that does two things. One, you're really going to see if the seller's willing to play ball, because you never know, they could counter you and come way down. But number two, you're letting the broker or the agent know, hey, like, you're serious, right? And these brokers, especially in the commercial side, when you give them an LOI to go give to a seller, it makes them look good, right? And it also gives them an opportunity to kind of test their client and see, hey, is this person serious or not?
And one thing too, and this is only going to happen for the next few months because of the way the market is, you can still get some seller financing as well in the back end. Like some sellers will carry. Like I bought a property in Coronado, had them carry back a 1.5 on it.
Yeah, gorgeous property, by the way. It's for the listeners out there. This is Coronado is probably the nicest piece of real estate in terms of dirt in San Diego. A little island out here, just outside of San Diego Bay. You got views of downtown to the east, and then to the west side of Coronado Island, you got the Pacific Ocean, really cool sunset views. But this piece of land, it's funny because I actually called on it, is like a corner lot. You actually have 3 streets on that lot that wrap around, right? So really nice asset, palm trees, a lot of land. and fourplex, but you can redevelop it and do a lot of different uses with that land. But it's funny, I called on it and the agent's like, yeah, it's about to close. And I was like,
Like
well,
Chris
any shot that this
Groves.
falls out? She's like, no, it's a done deal. And come to find out, it's my boy
It's
Chris
this guy.
Groves.
Well,
Congrats, bro.
if you didn't get in fast enough, the same thing,
Yeah.
and I watched that property for a while too. So I was in the market at 4 and I picked it up for, 2.9 ish.
Wow.
Right.
That was
So
the initial pricing was four?
it was 4. It was like
Wow.
4, a little like 4.1 was the initial. And I was like, it's too high. It doesn't pencil out even, and then when I went through it, I mean, I think I paid for what it was worth. Obviously, I got
And
a
you
deal
got
done.
seller carry on the back end?
Yeah.
Wow.
Yeah.
Dude,
So,
that's great.
so the blended rate, right? I got a decent interest rate. I think it was at 7.65 on that, plus the carry at 5% IO.
What was the note on that thing? Not the seller carry, but the first loan you did.
Well,
What percentage was that?
It was
What kind of leverage?
50%.
Okay.
Yeah.
And you got wow. So
Yeah.
you got in for low money down.
Yeah.
Dude, that's sick, man.
Way to do it.
Yeah.
But you can make those in this kind of market when people want to get deals, right? If they're sitting on it, like ask. You don't know if they'll do it unless you ask and present those kind of things. Ask the agent, would they be open to that? Like those are the kind of conversations you need to be having with your real estate agent. And if they're doing their job right, they go to bat for you.
Yeah. No, that's good, dude. So anyways, I think out there we got all these different like news in the marketplace. I think things are going to heat up really quickly. Spreads are going to start to come down. Now, real quick, just for the listeners can understand here, you got the federal funds rate, right? And then these lenders have their spreads. Can you elaborate a little bit on how that works?
Well, yeah. I mean, the note rate from the Fed doesn't mean that's correlated to an interest rate, right? It's going to, depending on the market, the liquidity of the market, who's actually buying these loans on the back end, how securitized they are, and investors like need or want to buy these notes as well, right? So when people watch the Fed rate, it's not always a direct correlation of interest rates, but the spreads are a lot leaner than they used to be years ago. There's a lot less money in even the mortgages these days than they used to be. Like it used to be a lot bigger spreads, but they've narrowed down a lot in the last couple of years. So it's a different game.
Yeah. And then what exactly is SOFR? Because I know a lot of commercial loan products are going over to SOFR. What exactly is that?
That's the floor rate of what is trading in New York. Basically, that's the floor rate. So like they'll say, hey, this is the floor rate of today's market, right? Just like watching the stock markets, whatever the floor rate is. I think SOFR right now is around in the 6s, and then they'll tack on their rate on top of that for the actual rate from that point.
Yeah. And then you got all these different loan products, and like you alluded to, some of these are funded by investors, some Wall Street, Fannie Mae, Freddie Mac, government agencies. Who funds those loans?
Well, Fannie and Freddie, they're going to be funded from themselves, right? That's a government entity. So when you're doing traditional loans like conventional, conforming, VAs, FHA, that's all government backed, right? So they're buying those notes. When it comes to non-QM, commercial, and those kind of products, those could be private investors, private groups that are buying those notes in the back end as well, or hedge funds, investment funds, insurance companies. So that's the difference. When it goes to a government product, government's always backing those, right? Especially in those entities. Everything else, it just depends on where they're buying the paper.
Yeah, because I got a couple notes with Freddie Mac on the multifamily side, agency and non-recourse. I believe multifamily and maybe mobile home parks are the only two asset classes they'll lend on non-recourse, meaning if you default, they're not going to come after your personal assets.
Yeah, I mean, and that's weird for them too that they do that. I'm still surprised that they're doing this marketplace, but that's more traditional in the commercial space, right? The private investors will do non-recourse. It just depends. I mean, obviously, you're always going to pay a little bit more for non-recourse typically because, obviously the protection on the back end of it.
But like for me, I've always been like, dude, like, I don't know. People are like, oh, I only do non-recourse loans. But I'm like, I mean, I don't plan on ever defaulting any loan because it's like, yeah, even if it is non-recourse, that's probably the last loan I'm going to get for a while. You know what I mean? And so in my eyes, I'm like, I don't really care if it's recourse or not because I don't plan on ever defaulting.
I agree. I mean, the one thing you have to do with the lenders that are non-QM or these commercial lenders is you have to ask for the prepays, right? So that's one thing a lot of people don't think about because a lot of these lenders have prepays. You're buying yourself back out of that product if you refinance it earlier or you sell it off. So that's one question you got to ask: is there if you have prepays or not? And usually most companies will be 6 months. More aggressive, sometimes a year or 2 years. So you got to ask those questions, or you can buy yourself out of those prepays as well.
And I always say, as a borrower or real estate investor, like there's certain things that are negotiable. And what I've learned is like the prepayment penalties are typically negotiable. Like let's say it's step down. I've been quoted, 5, 4, 3, 2, 1 step downs, and I've been able to negotiate like a 3, 2, 1 step down.
Yep.
And you might pay a little bit higher rate, but if you know, hey, you're going to refi, it might make sense to negotiate that. So you got the step down prepayment penalty. And then you got the yield maintenance. So yield maintenance really is, they'll look at the interest that they're going to be, the lenders are going to be collecting over the till the maturity date of the loan. And they'll say, okay, if you're going to refi out or pay off this note, okay, well, how much interest are we going to make between now and the maturity date? And based on the interest rate today, this is the percentage that we're going to collect. And so there was like a period in like 2021 where the rates were like 2.5% on multifamily. So a lot of these commercial deals that were bought on yield maintenance were like killing these deals because they'd be like $1 million prepayment penalties.
Yeah.
And so a lot of deals would just go dead because of it. So yeah, it's kind of confusing to explain the yield maintenance, but I think you step down, you can always negotiate it. And it's something that's easy to understand.
Yeah, I mean, we're seeing now that you brought it up. So yeah, we're seeing lenders, when it comes to people buying those properties, that if they're going to refinance, they're going to pay back the yield spread on that. They want so many interest payments to make sure they're going to secure that loan in the first place. So they sign on that these days, especially for commercial. That's pretty common.
Yeah.
Your biggest partner in a real estate deal is always your lender. For me, I prefer using someone I know, like, and trust, whether you're looking for commercial loans, residential loans, bridge loans, DSCR loans, no debt to income ratio, no tax returns. My guy, Chris Groves, has got you. As seen on episode 77 and episode 142, Chris is a good friend of mine and is doing a special offer for podcast listeners, $2,500 off of your closing costs and or appraisal fees. Visit grovescapital.com/Rich Summers to book a free call. Again, it's grovescapital.com/Rich Summers to book a free call. Now back to the show.
For the folks out there that have, and I didn't even know this product was a thing until a couple years ago, but a lot of folks assume if they get into real estate investing, they're like, okay, I want to buy a property and I got no debt to income ratio. Maybe I don't have tax returns, whatever, to show. I'm not going to qualify. Well, that's not the case.
DSCR.
So you got a DSCR loan, which is a non-QM product.
Mm-hmm.
What does a non-QM product mean?
Just non-traditional lending. It's not going through Fannie or Freddie like we talked about. So it could be private financing, it could be hedge funds, it could be insurance companies. So that's who's writing the paper.
Yeah. And so DSCR loan, how are you guys able to basically write these notes for folks that don't have any income to show? They don't have debt to income ratios.
Well, it's always to the non-QM lenders, right? Like, so most of the time when we're buying those kind of properties, they're investment properties. They're using the income qualifications of the property or future income that the property could create, turning into a business as using that as to qualify the client for the loan. We have products that you can use a P&L only letter, or CPA letter. No tax returns. Obviously, the less you show, the higher rate's gonna be. But yeah, we do it like these days. We have products like almost like stated income. Like literally, your CPA can write you a letter of your business transactions, and they'll use that to qualify you for the loan. And then obviously use the rental income as well. So it's pretty cool.
Yeah, I think it's a cool product. I mean, I always think of it as like, okay, in the residential space, if you're going to do a conforming loan, let's say FHA, primary residence, something that's, Fannie Freddie conforming, there's going to be a whole underwriting process. They're going to look at your debt to income ratio. They're going to look at how much money you're making and that sort of thing. And there's a lot of hoops to jump through. But on the commercial space, it's like, hey, you go take down a larger commercial asset. They're going to look at the income that this property is making. And then also they're going to underwrite the asset, but then also the experience of the operator. Hey, how much experience this operator has as a real estate investor? But some of those loans can be a lot easier to get and also lend to an entity. So, we take title, we take these notes. The note will be to the actual entity, and then you will sign as a member of the entity, and there will be a personal guarantee. Typically, it's someone that has a net worth equal to or greater than the loan amount. If you don't have it, well, that doesn't mean you can't do the loan. Well, go partner with someone that has the net worth, bring them in and you give them a little split for guaranteeing that note. I've done a couple in the past when I was kind of newer into the game, brought in a loan guarantor. And now people are asking me to, come in and they're giving me a slice of equity to guarantee their notes, which is pretty cool. But that product on the commercial space really is a DSCR product, but on a smaller scale.
Yeah. I mean, it's the best way to buy properties because it comes down to being logical, right? Like when you're using a typical lender, the DTIs and calculating all the different nuances, a lot of times you're like, I have the money, I can make this work. And lender's like, nope, sorry, it doesn't work. It doesn't hit our ratios, right? Where the non-QM, the DSCR loans, well, it's going to be more, sense-based lending typically too. And like you said earlier, as far as how much experience you have in the space is a really good determiner of how a better rate you're going to get. Now, we do have products for the first-time investors. Obviously, yes, your rates are always going to be a little higher being a first-time investor, or like you said earlier, bringing in a partner. Usually, they like to see three, like you've done at least 3 projects before you kind of be called a seasoned investor, and then you'll start getting better rates from there. But you got to get your foot in the door. So you either go for the product that doesn't require seasoning or partner with someone that has, and you get your foot in your door and you get better rates from there the more you do.
Yeah, I love that. And then in terms of if you're going to have multiple partners, from what I've seen, kind of general rule of thumb, I'm going through this right now on a 44 unit hotel that we're buying up in Bodega Coast, Sonoma County, California. Is any partners that are 20% or more ownership will have to go through an underwriting process, and they'll also have to sign on the loan. And so, think about those things. If you're bringing in partners, if they don't want to sign on the loan, then they should probably be 19% or less in terms of an ownership percentage. Outside of, when you're getting underwritten, these lenders are determining, hey, is this a note that we want to do? Outside of this, the experience of the borrower, what other main things are they looking at?
It's gonna be location too that matters, like a lot of rural areas and hotels in rural areas. Like obviously, they're gonna look at the investment as a whole. If they have to, like from a lender point of view, if you're lending your money, you want to look. If I have to take this asset back, what am I gonna get for it? Right? Is it gonna be good for me if like in that instance? So that's the way they look at lending, especially in the non-QM or commercial space, because like, hey, if I got to take this asset back over, what's my number gonna be on it? Right? And that's why certain leverage for certain properties, like some commercial lenders won't touch it 60% LTV or under. They'll touch it. And when it comes to 80, 90%, a lot of people stay away from it unless it's like in a really good area. So location's a big thing. Obviously, how much value add you can make to the property and bring up the income for the property is always a viable thing. And obviously, we want to see a game plan on that. We want to see an exit strategy, what the future ARV is going to be after you're doing those renovations. You're almost writing a business plan for a lot of these bigger properties and say, hey, this is we're buying it X. We're going to put this much money into it. We're going to raise the rents from here. Now the property's be worth Y. And then the lender wants to see that full picture, make sure you have a game plan because, they don't want to give it to someone that's never done this before because if it falls apart, they got to pick it back up to pieces.
Yeah. And I think when you're doing a value add project like that, especially a bridge loan or hard money loan, in terms of their appraisal, they're going to want to kind of see two numbers, right? So if you're buying on the flip side, primary residence property, they just want to see one appraisal. What's the as is value of this property today while we fund this loan? Now, you go do a bridge loan or a hard money loan, this property is typically not going to be stabilized. It's going to be underperforming. There's some sort of value add component. You're probably picking it up at a discount, but there's a lot of work to be done to get it to a stabilized property. So they're going to want to know, okay, what is the as is value today and against the purchase price? And then what is the stabilized value, the ARV, right? And then typically they're going to lend, they'll have their parameters. So some lenders might go up to 80, even I've heard of as high as like 90% loan to cost, but they're going to cap it as a percentage of ARV or stabilized value. What are you seeing most bridge lenders right now in the commercial side kind of capping this stuff at?
I think most all day long, 65, 70 is pretty consistent.
Loan to cost?
Yeah,
okay.
Loan to cost. Do I have lenders that'll do at 80? Yeah, 80 is, you're probably getting a good deal. 80 LTV to do bridges right now. They can be done. They're harder to find, but I would say easiest 75 is pretty common in this market environment.
And then what about like percentage to ARV? So let's say stabilized value, just for simple math, is 10 million. Will they still go up to like 65, 70% of the stabilized value?
Typically.
Yeah.
I mean, like that's the biggest thing with commercial people to understand. It's not about the square footage price. It's about the value of income you're bringing into that property, right? And that pathway of how you're creating that and how you're going to stabilize it from that point. So that's why a lot of people don't understand commercial is in residential. And most even for residential, like over 2 mil, they'll usually require two appraisals anyway. So it's usually more about the value number, right? Because you start getting those bigger numbers, you can have bigger variances between appraisals, right? $100 to $400,000 swing on an appraisal is a bigger difference. So
it's huge.
And that's really what it is. That once it goes over 2 million, that's why typically it's two appraisals in that market.
Yeah, I always feel like depending on the asset type, these appraisals can come in all over the place. For example, that fourplex you bought in Coronado, or buying like another fourplex anywhere here in like a metro area like San Diego. It's relatively easy to value. You might have, you could probably ask 5 appraisers to come in and value it. They're all going to be, generally speaking, in the same area, but like a luxury property, like a luxury $10 million property in like some like suburb of Florida.
Yeah.
It's like you just did a full renovation on. I mean, that could be a $2 or $3 million swing if you ask 2 appraisers. You know what I mean?
And I started off.
Like, how do you value those properties?
No, it's very tough.
Subjective.
Yeah, and I actually started off in this business as appraiser. That's why I started off in real estate.
I didn't know that.
Yeah, that's how I first started out. And for me, I took it seriously, but a lot of appraisers don't. Like they don't even go look at the properties. They look at it online. They do based on square footage. They're not doing the true work. And that, I've seen deals get killed because appraisers don't know how to do their job. So it's still an opinion of value. It's an appraisal is. It's not a definitive of value. It's an opinion. So. And it gets frustrating when you're doing especially on our side, when an appraiser does a shitty job and doesn't do things correctly and jacks up the deal and he kills it, right? Because that does happen pretty often as well. So it is important to make sure, us as lenders are working with good AMCs that have quality appraisers that actually know what they're doing in addition.
What is AMC?
It's appraisal management companies. So we can't ever have direct control with an appraiser because it's illegal on the lending side.
Mm.
So we have AMCs that we like this company, but we don't have any direct correlation, but we make sure the lender is approved with the AMC to go out and do the appraisal.
Okay, that makes a lot of sense. And I always say, as a real estate investor, it's like, okay, well, if you're going to do a refi, obviously you want to maximize your loan proceeds, and you want this value to come in as strong as possible and be a good reflection of the work that you put in for not just yourself, but for your investors if you do have investors. But I always say, go above and beyond and build a relationship with the appraiser, make their job easy. So like sometimes I will even like come up with like a 4 or 5 page deck with like photos of our business plan, the scope of work that we did, the before and after photos, exactly how much we put into the property. And then I'll even outline some comps that I think are relevant comps just to make the job easier for the appraiser. And then to take it a step further, what I've even done is like just recorded like a quick 5-minute Loom video going over the deck and just explaining exactly what we did the property. Boom, here you go. Here's a deck. Here's a quick video. Let me know if you have any questions.
Super smart.
Yeah.
As a client, you can do this. That's a great for your listeners to understand that. Like, yes, you can influence a little bit, but us as lenders, we can't at all. So like in the good old days, yes, you could talk to the appraisers director like, hey, do this, that. That's very, anti-lending business at this point. So yes, so you as the borrower, you want to say, hey, presenting in that manner, I think it's genius and I recommend it. It's amazing.
Yeah. And not saying, hey, this is the number we need, but just saying, hey, this is the scope of the work, what we did. Here are some comps. Let me know if you have any questions. And that's it.
As long as the appraiser doesn't have, just have a chip on his shoulder, they take offense to that. You have some, sometimes you get those people too. It's like, hey, I know what I'm doing.
Dude, I did have one. This is kind of funny. So I was doing a refi. This is a luxury property that I bought a 1031 into in Scottsdale, early 2022. Bought it for like 2.4, put in about 800, and then it appraised at like 489.
Nice.
And so we get 2 appraisals, but one of the first 2 appraisers, and I did exactly what I just alluded to. And I actually went out to the property to walk the property with these guys, and this dude was like super cool. But anyways, I get a call from the lender the next day. He's like, hey dude, like this guy's not going to use your appraisal. He's basically turning us in for influencing the valuation.
Yeah.
And I was like, Jonathan, what the fuck does that mean? And he's like, no worries, you're good. He's like, we're just going to get another appraisal. So, long story short, we got another appraisal and it came in, very close to what the highest one came in at. And so they used I believe the lower of the 2.
Yeah.
And we got the loan done. So, that was an interesting experience, but
you were putting on too much charm, buddy.
Well,
too much charm.
Yeah. It's funny because I was like playing ping pong with the appraiser. I think we were even shooting hoops at the property at one point. The guy was super cool. So I was shocked that he actually did that. But and then 2 weeks later, this next appraiser comes through, and I was like, we had a really good number with one of the appraisals that came in, and I was like, Jonathan, dude, I'm just gonna shoot this first appraisal over to this guy. And so I just emailed him. I said, hey, here's a deck of what we did. I said, here's another appraisal that came in. Let me know if you have any questions. I just attached it, and that was it. He didn't say anything, and that was it. So, I think it also highlights it's the importance of working with a good mortgage broker that can help you navigate through those situations.
Yeah, exactly. And like what you said earlier, appraisal is still an opinion. So I think that way you did it the second time, that's definitely the way you should do it. Just, hey, this is what we have. So he's obviously going to use that. Obviously, once you see that and the valuation of multiple people, that's what's going to help get to the number.
Yeah, no, absolutely. What do you guys do if you guys have, let's say you're sizing up a deal, appraisal comes in really low. What do you guys typically do in that scenario? Do you get another one in there?
So yeah, we can fight AMCs, but the one thing is, I've been doing this a long time. Rarely do they come back and go, you were right.
Yeah. Can you not present it to that specific lender and then get another appraisal?
So yeah, you can if it's very like off basis, as long as the lender says, hey, you can get another appraisal, like they agree with you. But you can fight appraisals, and sometimes it goes good. Sometimes I would say 80% of the time, these appraisers take offense by that, and they just like, nope, that's what it is. They don't want to play ball because they don't care. At the end of the day, they're getting paid for what they did. They're not getting paid if this closes or anything else. So, and that's really what it's supposed to be. That they have no influence. So yes, otherwise get another appraiser that you feel that's gonna be qualified to do so. I have appraisal management teams. Like if something's questionable, I'll send it over there for a review prior to an appraiser going out there. So at least I'll have a viable choice. So if I have one of my clients call me and say, hey, we're not sure if it's going to hit, I'll send it to an appraisal review team first to the AMC. Just say, hey, what do you guys think roughly based on what you're seeing? So I know what I'm playing with before I send it there as well.
So that's kind of a way to know, like, hey, is it worth spending the cost of appraisal Like, is this price point that we need even in the realm
Yeah.
of possibilities?
Yeah, and a good mortgage lender should know how to do that, and like have those teams that can at least look at the valuations, from their side, and a good appraisal company should be able to do that as well for you,
Mhm.
right?
It's funny you mentioned though that like after the fact of the appraisal, a lot of these appraisers they're not gonna come back and adjust the price because it kind of makes them look bad. And I think that's as an investor, I think it's even more reason to kind of go above and beyond on the front end and
Yeah.
just outline exactly what you did and obviously be super friendly, build the rapport
Yeah,
because that's probably your best chance to communicate to the appraiser, make their job easy,
yeah,
and get the number that you're looking for.
their job's already easy. Let's be honest.
It is. It is pretty easy.
No, it's not. Yeah, it's not rocket science. If a good appraiser, like I rarely ever see. I've had good appraisers even come to my houses. They're the ones that actually go with the measuring stick, take ever the measurements, take
Yeah.
photos. Like how often do you see an appraiser actually do any of that stuff? They
Oh,
go out
I
there.
don't think I ever have.
No, they go
Yeah.
online. They do their little back and forth. They go to the property, say they're there, take a couple photos, and they take off.
Yeah.
Or in the last 3 years, a lot of people are doing drive-by appraisals, right? Like they don't even go in the property, like taking a picture and then taking off, and they're getting paid astronomical numbers for it. So a good appraiser should actually be in there, measuring everything out, taking good photos, actually asking questions, checking call spaces. But it's a rarity. Yeah, that's what I used to do when I used to appraise. Like get in there.
Dude, I'm curious, since you were an appraiser, how much can you make annually as an appraiser?
I mean, the appraisers, like typically you're making anywhere, $400 to $500 on a file typically, right? So, I mean, how many do you do in a week? So if you're doing, I could pop out 4 to 5 appraisals a day, right? So,
Wow. That's
But-
pretty good money.
yeah. You
So
gotta drive around
I'm
a lot
just
there.
doing the math. So
Yeah.
you do 5 a day, 4 days a week. That's 20 appraisals.
Yeah. If you're doing good.
And then, I mean, some of these commercial appraisals though,
Commercial's a lot higher,
but
yeah.
but you're not doing 4 commercial appraisals in
No.
a day, right?
Yeah,
You might do-
commercial, I see anywhere from $3 to $6 grand typically for
Yeah.
a commercial appraisal. Once again, like why? Like why is it that much different than a house? It's
how
not.
many commercial appraisals could you do in a week if it's all commercial?
You usually can do like 2 it depends on the size of the property, like
Yeah.
anything else. But yeah, you can do at least 2, probably 2 a day typically.
Yeah. So as an appraiser, what kind of money do you think you can make if someone's just really like doing it the right way?
I would say average. I mean, the guys I work with, they're doing probably 300 to 500 grand a year if you're doing good. I would say an average appraiser, if they're doing decent, like 6 figures. It's not crazy, but you're not dealing. You're dealing with a job that's you're making an opinion of value. So you're not making a win if you're selling. So you have no incentive. So it's limited, but it's a good way to make money. It's like being a notary, right?
Yeah. And I'd have to imagine, like, as an appraiser that became a real estate investor after the fact, I mean, you would have a good understanding of your local market at least.
You should. You should.
Yeah, that's crazy. Yeah, I didn't know they made that kind of money. It's pretty lucrative.
Yeah. Well, it's how many you do as well. Well, remember, the market's slower now, not as many transactions. So a lot of these appraisers, like, through COVID, we were getting jacked up prices. Like I saw appraisals for like 2 to 3 grand for appraisal that used to cost $600 during that time. So they made their money during that time. And it was, I'm surprised it never got regulated like heavier after that. Now, obviously there's less. So hopefully they saved up their money like everyone else for the boom. Otherwise you're not doing as much right now.
Yeah, we always, whenever we get the appraisals, we'll typically get a list from the lender of like, these are your 4 or 5 options. This is the turnaround time. And so for us, we're always like pressed for time. So I always go with the quickest turnaround time and the most reputable company. So it's like, if it's some third party I've never heard of, I just know that it's not going to hold as much weight with these lenders as like a Collier's or like a more reputable firm. So for us, we always go at the time, but I think we spent $5,200 on the most recent appraisal we did on this 44 unit hotel up there, but it was a quick turnaround time. It was like inside a week.
That's good. Yeah.
Yeah.
It should be. It really doesn't take that long to do it. Just depends how much is on your desk, really. But I mean, typically 24 to 72 hours if you're good.
With real estate investing, asset protection and protecting yourself from personal liability is huge. The best way to address this is to correctly set up your LLCs and entity structure. For us at Summers Capital, we use Prime Corporate Services to set up, manage, and provide guidance for all of our entities, making it truly hands-off. If you want to learn more, visit primecorporateservices/Rich Summers to book a free call and receive a special podcast listener offer. Again, visit primecorporateservices.com/Rich Summers to book a free call. Now back to the show.
So, we're talking about leverage with these bridge loans. And I always say, like, as an investor, you want to make sure when you get these bridge loans, because these are not permanent financing. It's not perm debt by any means. So, it's a temporary loan. You're going to be in it for 12, 18, 24 months. And then once you stabilize the property, you either sell for a profit or you refinance into some perm debt and hold the property. But I always say, like, the amount of leverage you take on is key, because you got to make sure, hey, when we go to refi this thing, if you're going to hold it, that you're not going to have to bring cash to the table to refi, And so I think right now, with the rate environment, and a lot of these floating rate mortgages that we saw on the commercial side, you're seeing a lot of folks refi into some expensive fixed debt, and they're having to bring cash into the table because the DSCR requirement is not met.
Yeah, and that's where there's an opportunity right now in commercial that a lot of people like need to start thinking about if you want to get into that space. You're gonna get your best deals even if the rates drop in the commercial space, especially like retail spaces obviously are gonna take a big hit, right? Like we're seeing right now. A lot of my commercial investors don't want to touch retail. Like it's very hard to get lending for retail, right? Because everyone's
Is it
leaving.
really? Do you think
Yeah.
it's harder than office?
Hardest.
Really?
Yeah, retail's
Why
hard.
is that?
It's just because how many businesses right now are going to have the money to make their payments? They're viable. They have the track record, and it's secure, right? Think of a restaurant. Like, what are the odds of them actually succeeding right now in the retail space? 10%, if that, maybe even less, right? So anything in the retail is the toughest. Second, I'd say land's the worst right now. Land's the worst, then retail. Then
And
I'd say office
land's
space.
just because land doesn't make any money.
No, I mean, like I had 5 calls a day for land, and anywhere from 20 to $800 million today alone. They're like, hey, I want lending on land. I'm like, okay, we got to throw up property. Well, I don't want to do that. The land's the collateral. Well, no, it's not. If you were a lender, what am I going to do if you default? I'm going to come and pick up my dirt and go.
Yeah,
I'm like, you got to.
it's hard to sell that.
But these guys are like, they're so sure. Like, no, I don't need to put anything up. The land is. It is something, but it's nothing in this marketplace. You always have to cross collateralize something else to lend with land, right?
Mhm.
So that's why even right now we're having an issue with new developments for even new home builds because no one wants to touch land. So I'm getting calls every day for people to come in as pref equity pieces on those kind of deals.
Mm-hmm. Yeah, the folks that I know that do a lot of these development deals are typically going in with cash to buy the land, and then going through the entitlement permitting process. And let's say it takes 18 months, and even 24 months in some of these areas of California. Well, then once they have that shovel ready, then they go get the lending.
Yeah.
Yeah.
Well, because if you don't have any holding costs on the land while you're waiting for permits, it's the best way to do it. But I mean, I get calls. I'm not joking. Probably 10 to 15 a week. Like, hey, I got a piece of land. I want a piece of development. I need you to search the senior loan and the pref equity. I'm like, so you have an idea? It's great. Like you got to put it all together. So that's where a lot of people like. It is one of the toughest things right now is land. So if you don't have other properties crossed, you have to at least get 50% LTV. Like I was doing at a deal this week that was $8.5 million piece of land. It's already entitled. It's already got ready for 171 homes. They wanted to cash out one of their partners for $3.25 million, right? So that puts it at like 39% LTV, super low. And they already have an LOI for someone to buy it in the next 6 months. And most lenders are like, no, I don't want it. I'm like, they have letters of intent to buy it. Their LTV is really low. They're like, well, they got to throw up other properties. And these guys are like, no, I don't want to throw up other properties. The land is the collateral. I'm like, they don't care. They don't want it. And they're just like, well, and they're yelling at me. I'm like, don't yell at me. It's not my money. I'm like, at the end of the day, what are they going to come take? So you have to throw up something else, and it's temporary anyways. What do you care?
And dude, honestly, like I don't mind cross collateralizing a lot of stuff because I'm like, if you have confidence in the deal that you're buying, why wouldn't you cross other stuff?
Well, especially if you have a sale in 8 months, and you're like, what's
It's
your risk right
it's
now?
short term, yeah.
Yeah. So we'll see. I had to come back with
Yeah.
them this week with a couple more options.
Yeah. And to your point, I mean, for the listeners out there that you're trying to get financing done, and let's just say that you're struggling to get a specific deal finance. Well, another method that you could utilize is cross collateralize another one of your properties. So if you have another property or two with equity, offer the lender to cross one of your other properties. Hey, I have $1.5 million, $2 million of equity in this other property. Let's cross it. I'm willing to cross it in second. And sometimes often that is enough for the lender, have a little more confidence going into and fund your deal.
Yeah, because at the end of the day, once again, as a lender, if I'm lending money on something, I want to know what I'm going to get back. So you fail, right? So if they know I'm going to throw up other properties, I have something else to come after. That's what they're looking for. So I always tell people, you got to think of it. It's your money lending it out. You do the same thing, right? And they're like, oh yeah, I guess.
Mhm.
So you always have to preference that way.
Yeah. What are your thoughts on the risks behind like personally guaranteeing a note? Because obviously, like I personally guaranteed all these notes, and I never expect a default on any of them. But like, what is the real risk there?
Well, number one is everyone puts everything in entities anyways, right? So depending on how good your lawyer and CPAs are, like most of the time, every time you buy a property, I'm sure you put it in a separate LLC,
Yes.
right?
And
So
there might be multiple LLCs and layers of protection before you get to me.
exactly. So smart investors, that's the way you got to do it. Put it in different entities. Now, nothing's fail safe against this from happening. So at the end of the day, I think like you, if I'm personal guaranteeing it, at the end of the day, if they want to come after me, they're going to come after me, right? And anyone can sue you for anything. It's one thing I've realized in business. Doesn't matter if it's viable or not, they can still take you to the lawsuit. So I really don't care about the personal guarantee either. Obviously, I personally come behind any deal I do. Otherwise, I won't be doing it. But yeah, I get a lot of kickback. Like, I don't want to personally guarantee it. I'm like, well, they're not going to do it, right? Like, at the end of the day, like, if you don't believe in yourself on this project and you're not going to back it, then why would they?
Mm,
And that's the way I always preface questions to people like that. Like, you have to make them understand that perspective. And then a lot of times, like, oh, okay, I get what you're saying now.
yeah. I don't mind personally guaranteeing notes if it's a deal I believe in, and I'm not going to buy a deal that I don't believe in. First of all, but people ask me, hey, well, do you want a slice of GP to come and guarantee us? No, I'll look at the deal. It's got to be a deal I really feel confident in, especially if I'm not going to be like, the operator of the deal, right? But I have heard of folks out there that don't feel comfortable personally guaranteeing notes. I'm like, well, it's probably not a deal you should be buying if you don't feel comfortable.
Yeah, but it's a common thing here, just like non-recourse. Like, people, there's always gonna be risk with properties, and like I said, they can always come after you regardless of what you signed. Especially in California, it doesn't really matter. To be
Yeah.
honest.
Yeah, no, that's true. Yeah, the insurance thing is big right now. Question for you guys. So when you guys are sizing up a deal, obviously the lenders are looking at DSCR requirements, especially for stabilized products. Typically, what is that DSCR threshold? Is 1.25, 1.3-ish?
Yeah, typically, I have some lenders that go 1-1 on it. It just depends. So, like, obviously, interest rates will go higher from that point as well.
And so for the listeners out there, DSCR basically is you take the gross income of the property minus the expenses, except for the debt service annually. Take that number, divide it by the new debt service. Now, do you guys factor the insurance to come up with the DSCR?
Yeah,
You
'cause
do.
that's obviously, yeah,
PITI, really?
Yep.
Okay.
It's still factored in there. Obviously, it's not as much weight as the income, but it's definitely still factored in.
Yeah. And so then you get this number. And so obviously the higher the ratio, the higher the leverage you can probably go. And the skinnier it is, probably the lower leverage you can probably go. So here in Southern California, San Diego, we're in a lower cap rate environment than an area like Cincinnati. So you buy multifamily out here, you're going to get lower leverage, but out there you might be able to get 75, 80%. Here, you bought that property in Coronado, 50%. Was that DSCR loan that you did?
Yeah.
Okay.
Yeah, and we talked about this earlier too, is like the insurance is going to be a big issue in California right now. All these insurance carriers are leaving Cali, and for a lender, like, a lot of people are not understanding this. Like, anything over $2 million, it's going to be tough. And obviously, as a buyer, even for single family or for investment properties, now if you're paying like double to triple what you're paying on insurance, that's going to affect your ability, your purchase power, right? And it's also going to affect closings. It's I don't think a lot of people are really thinking about this right now, but it's a problem, and it's going to be a big problem.
What closing? What do you mean?
So, as far as like even for taking my primary home, right? Like, my insurance was, let's say, $1,300 a month. Now they're jacking up to $5,600 a month. Like, that's another mortgage for most people, right? So for me to qualify that house, like when I first bought it with that insurance, would I have qualified? I don't know. It would have been a lot tougher, right? Because my DTI is gonna be a lot increased from that point. So a lot of times now, like anything over $2 million or $3 million in California, especially in San Diego, a lot of these insurance companies don't want to touch it, so they're going to jack up the premium 3 times what it used to be. So now your DTI is going to be totally off. So your purchasing power is going to be less,
Mm-hmm.
right? So thank you, California.
Yeah, I know. It's crazy.
Yeah.
It's crazy. We've seen stuff in the boutique hotel space. I mean, the insurance premiums are all over the place. Folks in our mastermind are sourcing deals all over, but like we've seen 10-unit boutique hotels in, Fort Lauderdale in flood zones or near sea level that are, premiums are coming back at $100K. This is for a 10-unit boutique hotel.
No, that's
Like,
crazy.
it doesn't even make sense. It just kills the deal. And then, we're with the 40-unit hotel that we just bought up in Lake Chelan, Washington. That was a 2021 construction, 40 units, and the premium came back at $17,000. So it's like all over the place. But that's a newer asset.
Sometimes
It's got
they
good
make
sprinkler
sense.
system, but it's all over the place.
Yeah, I talked to my insurance agent yesterday. My primary went up to $30,000 a year for my primary. In that new Coronado property, $3,600 a year.
Wow.
I was like, it's still a multi-million-dollar property. I'm like, where, like, how? Like, what is this discrepancy? I'm not even understanding. Like, that's going to be an investment property. People are going to go in and out all day long. This is what I live in. So you would think the risk is higher here than my primary, but, can't explain that part.
I got a question for you. So if I wanted to buy, I'm kind of interested in buying like a really cool like luxury like villa down in like Tulum.
Tulum. I got friends.
Yeah. Yeah. What would lending look like down there on that? I know international lending is like a whole different ballgame, and interest rate environments are typically much higher than here. But is that something I would probably just want to pay cash?
So you never own the properties, number one. It's 99-year lease. Typically, I'm getting rates in Mexico.
You can do lending in Mexico?
Yeah, I can do.
Dude,
Mexico.
you do it
I do.
all, man.
Yeah, we do international now too. So
Wow.
yeah, Mexico 8 or 9% is pretty typical there.
Okay. That's not too bad.
70% LTV typical
Really?
as well. Yeah.
Okay.
Yeah.
And new construction villa, you probably get.
Yeah, we can do about the same. Yeah, it's pretty clean. Actually, I just started working with one of the biggest families that pretty much developed all of Cabo. So we're working on a big development with them right now. This this family owns everything, and in like they're not even using Mexican banks; they're coming to us right now because we have better leverage.
Because, dude, I'm seeing like these new luxury villas. A bunch of folks that I know have like different developments down there, but you buy a nice luxury villa down there for $450. So you're saying 30% down.
Yep.
Can use it whenever I go down there, and then when I'm not using it,
Rent
it'll
it
be a
out.
short-term rental.
Yep, exactly.
I
Yeah,
like
that's
that.
a good play. Yeah, I have a lot of friends that are buying Tulum right now. I have one buddy that's developing a whole thing down there as well, and like he'll be selling them off. So yeah, I think it's a great play. Just got to understand the government entities there and make sure you buy it in a trust as well, because there's ways around that. With Mexico is a different country, so you got to make sure that's done correctly.
Can you explain what that means? So when you're buying with the trust, is the note actually to the trust?
Yeah.
It is.
Yep.
And what does that do protection wise?
Well, it protects it for longer, right? So Mexico, like I said, it's a land lease. You're not owning the property, right? So a lot of people don't know you don't technically own it. It's a 99-year land lease. You don't own any property in Mexico. So whether that's you're never going to live out to see it unless you pass it off to your kids, and who knows, you can take it back after that time. They can do whatever they want technically. So that's why you will definitely want to buy it in a trust there and make sure it's a Mexican trust that protects you and your family to keeping that in your portfolio for long term, right? So they can take it out.
Yeah, dude, I love that. Dude, so you guys are all over the place. So all 50 states, you're doing Mexico as well.
Yeah.
Where else do you guys lend?
Right now I have a project in Bahamas, Belize, Cabo. Those are the big spots I have big lending. I've got a couple huge hotels in Nevada right now, and Vegas that we're working on right now. But yeah, I get weird stuff all the time, like Belize, like I hit up on today. So usually if there's an opportunity and it looks like it's a good deal, I'll find a source for it. That's what I'm known for. So
Can you guys do hotels in Belize and Mexico?
Yeah.
You can.
That's what we're doing right now, a hotel in Belize, and that one's a casino, airport, and condos and a hotel. And then Cabo is going to be a whole luxury resort, homes and clubhouse and all that stuff right now.
Dude, that's pretty cool. I know I have a couple friends, and she's been on this podcast, Investor Girl Britt, and then also our SEC attorney, Bethany LaFlamme. Shout out to Bethany, but they both partnered on a boutique hotel down in Belize. They got seller financing on that, but I know at some point they're going to either be selling and that buyer will be looking for financing, or they'll be refinancing once they add value.
Belize is going to be one of the new hot zones.
You think so?
I'm a big believer on that.
I've never been. Why do you believe
that? I've
that?
been either, but it's still cheap. It's beautiful waters. It's clean. The government's pretty easy to deal with for the most part. So it's going to be another big hot spot.
Is it trendy with like the younger people like Tulum is?
It's starting to get there. I mean, I think Tulum's kind of had its day, and now it's getting like too corporate and too expensive. I just had friends go a couple weeks ago. I was supposed to go, and they came back. They're like, it was like $100 cab ride for like 2 minutes down the road, and you bought like a t-shirt. It's like $300 t-shirt. I'm like, dude, it used to never be like that, right? So much money came down there, and now they're like, oh, we charge wherever we want. These guys are going to pay for it. So there's always a new hot zone that's more of the vibe and chill until everyone goes to that spot, and then you got to find the next one, right? So, but I do believe Belize is going to be like kind of like Bora Bora kind of vibes. Experience, still cheap to buy land, it's good quality, the government's pretty easy to deal with as well, so those are all perks.
Yep. Speaking of traveling, I know you and Aleyna like to travel to some pretty exotic spots. Do you guys have any cool trips planned for 2024?
I literally mapped it out the other day. I have my top picks right now, so it's either gonna be like Tokyo, Dubai, or we're gonna do like Spain, Madrid, kind of like that kind of vibe. I really want to go to Tokyo. We were talking about Fastlane opening up a Tokyo chapter, so they do. I'll probably go out that way, but I love Japanese culture and the food, and I've heard nothing but great things. So ideally, probably want to go that way, but we'll see.
Dude, there's a nonstop flight on Japan Air, San Diego to Tokyo, and get there in like 8 hours.
I was looking for it the other day, and it was like I didn't see it.
You didn't see it?
Yeah, because my friends told me about that. So and then
maybe
I
it's
did
not there anymore.
Yeah, well, maybe, but yeah, I would love to do that. But the last time I looked, it was like astronomical, and it wasn't that. So I don't know if they discontinued already, but yeah, it's only like 8 or 9 hours from what I heard.
I was like, dude, like, because I love sushi, and obviously like Japan has all sorts of history, but I was like, you can go out there for a 4 or 5 day weekend if you had a direct flight, 8 hours. That's not too bad.
Yeah, exactly. I gotta look again, because the last time I looked, I couldn't really find it. So I don't know if they cut off that program or switched it around, but yeah, not bad for 9 hours.
Yep. Well, dude, I appreciate you coming on, man. For the listeners out there, super excited about our affiliate. So Chris, obviously with Grows Capital, going to be doing an affiliate with the listeners, a really cool discount for you guys. So if you guys need commercial lending, DSCR loans, residential, primary, whatever it is, he's got you covered. You can go to grovescapital.com/richsummers and receive $2,500 off for all the listeners towards your closing costs or appraisal fee That's massive. So thank you so much, man. Appreciate it.
Of course, yeah. We pretty much everything in the lending game we can handle. Over 200 different lenders, private investors, private New York money and Miami money as well. Especially for the bigger projects that most people can't fund, we can do in the billions at this point. So just give us a shout. Our job is to get you the best pricing based on those lenders and give you the best products.
And $2,500 credit, man. That's
and
no
a
joke.
$2,500 credit with 110% effort every loan, baby. Let's go.
Let's go. Cool, man. Well, I appreciate you. And dude, we got to do an event soon, man. You mentioned Miami Fast Lane Drive in March. That one sounds pretty exciting for me, man.
We're doing it. See, we've agreed.
I love it. He's Chris Groves. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.